This video provides more detail about the income statement. During 2000XX, the management of Harbor Island Company managed its available assets to generate revenues of $43,500, which exceeded expenses of $33,500, leading to net income of $10,000, all of which are described on the income statement, a record of the financial performance of Harbor Island during 2000XX. We now provide additional detail about the income statement. Here's an example of a complete income statement. It provides a record of how well Harbor Island Company performed during the year ending December 31, 2000XX. It is comprised of two basic categories. One, revenues, which are recorded as services are provided for clients, service revenue, and products are delivered to customers, sales revenue. And two, expenses, the costs incurred by the company during the period necessary to generate the revenues. The result of matching the expenses against the revenues is called net income, net profit, or net earnings, the famous bottom line. The income statement is also organized to make two additional important distinctions. First, operating revenues and expenses, which refer to the normal, recurring, and everyday business activities of the company, are distinguished from other or non-operating activities, which are either non-recurring or unusual to business operations. This distinction is useful because it highlights net operating income, which results from normal activities and in that sense can be expected to repeat with reasonable frequency in the future. Other revenues and expenses are not central to the company's primary operations and may be less reliable and therefore less likely to occur in the future. The complete income statement also includes a section devoted to disclosing earnings per share. This disclosure simply divides the primary elements of the income statement, for example, net operating income and net income, by the number of equity shares outstanding. Earnings per share is used by many as a measure of the company's performance for the year. Let's now focus on each individual income statement account, starting at the top with service revenue. Service revenue is the sales price, the dollar amount charged to the client, of all the services performed by the company during the year. This amount is recorded as the service is being performed, not when the cash payment is collected by the company. Sales revenue is the sales price, the dollar amount charged to the customers, for all the goods delivered by the company during the year. This amount is recorded as the goods are delivered, not when the cash payment is collected. It is important to understand that revenues, both service and sales, are recorded when they are earned by the company, not when payment is received, which may occur before, during, or after the earning process is complete. Recall that the actual cash receipts associated with these transactions appear in the operating section of the statement of cash flows. Operating expenses represent the normal everyday cost associated with earning the revenues. Cost of goods sold is the cost incurred by the company associated with acquiring the inventory that was sold during the year. The income statement tells us that inventory with a cost of $10,000 was sold during the year for $25,000, leading to a gross profit on these sales of $15,000, $25,000 minus $10,000. In other words, Harbor Island acquired inventory, which it marked up on average by 2.5 times, $25,000 divided by $10,000, for sale to its customers. For example, a good or item acquired for $10 was sold to customers on average for $25. Wages and salaries refer to what the employees earned during the year. Similar to revenues, the expense is recorded when the obligation to pay the employees is created, not when the actual cash payment is made. The same is true for the costs associated with advertising, insurance, utilities, and state and local taxes, as well as a relatively long list of possible other expenses. That is, the expenses recorded on the income statement when the obligation to make the payment is created, not when the actual cash payment is made, which may come before, during, or after the obligation is created. Recall again that the associated cash payments appear in the operating section of the statement of cash flows. Depreciation and amortization expenses represent the amount of the cost of the producing assets, property, plant and equipment, and intangibles, converted to expense during the year. Each year, a portion of the cost of these assets is considered an expense because these assets are gradually being used up to support the company's operations. Depreciation and amortization expense are called non-cash expenses because the entry to record them illustrated in the box involves no cash payment. Since these expenses reduce net income but do not affect operating cash flows, they are one of the primary reasons that net income does not equal net cash from operating activities. Miscellaneous expenses simply reminds us that there is a number of other possible operating expenses that could be listed on the income statement. All are costs used up in the current period in an effort to generate the revenues recognized in that period. This brings us to net operating income, which is the result of subtracting operating expenses from operating revenues. Many income statement users rely heavily on this number because it is designed to provide a relatively reliable measure of the performance of the company's central or primary operations. Other revenues and expenses relate to the company's secondary activities. The most common examples are interest income and interest expense. Other examples include gains or losses on the disposal of non-operating assets, losses due to workforce reductions, and lawsuits. All of these items are not central to the company's normal operations. This brings us to a second income number, net income before taxes. It is useful because it reflects both operating and non-operating activities, but is considered less reliable or repeatable than net operating income. Income tax expense is then subtracted from net income before taxes. It is important to understand that income taxes are assessed by the federal and in some cases the state government based on a company's taxable income, which is not the same number as net income before taxes on the income statement. The income tax laws for measuring taxable revenues and tax-deductible expenses are in many ways different from the rules used to guide the measurement of the revenues and expenses reported on the income statement. Finally, we come to net income, perhaps the most relied upon measure of a company's success during the year. As indicated earlier, net income is the result of revenues less expenses, and it is owned by the company's shareholders, who can withdraw it or leave it in the company. Under generally accepted accounting principles, an earnings per share disclosure is required on the face of the income statement. Net operating income of $13,200 was divided by 1,000 outstanding equity shares to come up with $13.20. The net result of other revenues and expenses, $1,500, was also divided by 1,000 shares to come up with $1.50. And the income tax expense amount of $4,700 was divided by 1,000 shares to come up with $4.70, leading to a total earnings per share amount of $10, which is equal to the $10,000 in net income divided by the 1,000 outstanding equity shares.